Good evening, everyone. Welcome to the channel. Before I begin, here are my disclaimers. Today I am going to give you an update about Carnival Corporation and PLC annual report. Carnival Corporation and PLC offers a diverse range of businesses and services to cater to the leisure travel needs of its customers worldwide. The company operates through four main segments: NAA Cruise Operations, Europe Cruise Operations, Cruise Support, and Tour and Other. Under these segments, Carnival provides various services including cruise operations, hotel management, railcar operation, and motor coach transportation. The company owns and operates numerous port destinations and islands, offering a unique travel experience to its customers. Carnival's portfolio of brands includes AIDA Cruises, Carnival Cruise Line, Costa Cruises, Cunard, Holland America Line, P&O Cruises, Australia, P&O Cruises, UK, Princess Cruises, and Seabourn. These brands cater to different segments of the market, providing a range of options for customers to choose from. In terms of sales channels, Carnival sells its cruises through various mediums including travel agents, tour operators, vacation planners, websites, and onboard future cruise consultants. This multi-channel approach enables the company to reach a wide customer base and provide convenience to its customers in booking their dream vacations. The stability in Carnival Corp's stock price over the past year can be attributed to several factors. Firstly, the lack of significant change suggests an absence of overwhelmingly impactful news that would have drastically shifted the stock price. This could be due to various news items having a neutralizing effect on investor sentiment. While Carnival Corp did experience significant positive news during this period, such as record revenues and net income for its 2025 fiscal year, these announcements often led to more substantial movements or were largely factored into the stock's performance leading up to the announcements. This suggests that investors had already anticipated and priced in the news, resulting in a muted market reaction. Furthermore, periods of lower volatility, where daily price changes were within the plus or minus 2.79% range, indicate that market reactions to news were often muted or neutral. In these instances, there was no major unexpected news event that drastically shifted the stock price beyond this threshold. Overall, the stability in Carnival Corp's stock price can be attributed to a combination of factors, including the absence of impactful news and investors' anticipation of positive developments. Carnival Corporation and PLC market capitalization of $38 billion is significantly larger than the average industry peer of roughly $6 billion. This shows that Carnival Corporation and PLC holds a significant advantage in their industry. Carnival Corporation and PLC trades at a lower price-to-earnings ratio of 14 times and a higher price-to-book ratio of 3.06 times relative within the industry. But when we look at the broader industry, much for its peers are also priced fairly or higher. This indicates an overall sector-level optimism, suggesting that most investors have already participated in the industry, leaving limited opportunity to uncover undervalued stocks. The company exhibits a very high leverage profile, with liabilities accounting for 81% of total assets. This elevated debt level warrants heightened caution, as it may limit the company's financial flexibility and increase risk during economic stress. We have to further examine the industry and the nature of the business to determine if they justify the current valuation. Average liabilities have declined over the past 5 years, indicating improving balance sheet discipline and reduced financial risk. Shareholder equity has declined over the past 5 years, but operating income remains positive. The equity weakness may stem from capital structure changes such as buybacks or dividends rather than operational deterioration. The share count has increased over the past 5 years, while revenue has continued to grow. This suggests the business may rely on shareholder dilution to fund expansion. Investors should closely monitor whether growth can eventually be sustained without dilution. The income statement shows that the company have been growing its revenue annually, but the operating income have not been increasing. This shows that the business is under pressure with rising cost. The primary drivers of revenue growth or decline in the cruise industry are multifaceted. On one hand, several factors contribute to revenue growth. The demand for cruises is a significant driver, as well as effective digital marketing and lead generation approaches. Investment in new marketing technologies and personalized communications also play a crucial role. Additionally, the entry of new ships, higher ticket prices, and favorable foreign currency translation impacts all contribute to revenue growth. On the other hand, several factors can lead to revenue decline. Incidents concerning ships or guests, adverse weather conditions, fuel costs, and overcapacity in the market are all significant drivers of revenue decline. The departure of certain ships from specific segments and cancellation fees also negatively impact revenue. Furthermore, refunds of customer deposits can have a neutral effect on revenue. It is worth noting that some factors, such as seasonality, cruise itinerary, and pricing, do not significantly impact revenue growth or decline. These factors are more related to the timing and type of bookings rather than overall revenue trends. Net income and profit margins. A changing landscape, the net income of a company underwent significant fluctuations between 2023 and 2025. In 2023, it was negatively impacted by adverse weather conditions, cybersecurity incidents, and data privacy breaches, leading to a decrease in net income. However, the following year saw an increase in debt servicing costs, higher fuel costs, and loss of key team members, further decreasing net income. In contrast, profit margins showed improvement in 2024 due to disciplined cost control measures, continued deleveraging, and measured investments in newbuilds and destination development. This was a notable shift from the previous year, when profit margins decreased due to disruptions caused by adverse weather conditions, cybersecurity incidents, and data privacy breaches. The trend reversed in 2025, with net income increasing significantly compared to 2023. Profit margins also improved in 2025, reaching a margin of 10.4%. The reasons behind these changes are multifaceted, but it is clear that the company's ability to adapt to various challenges and implement effective cost control measures played a crucial role in its financial performance. The fluctuations in net income and profit margins highlight the importance of resilience and strategic decision-making in navigating complex business environments. As the company continues to evolve, it will be essential to maintain a focus on cost management, innovation, and risk mitigation to ensure sustained growth and profitability. The company is indeed generating positive operating cash flow. This can be seen in the significant increase in net cash provided by operating activities over the past 3 years. In 2023, the company generated $4.2 billion in operating cash flow, which increased to $5.9 billion in 2024 and further rose to $6.2 billion in 2025. This upward trend indicates a steady improvement in the company's ability to generate cash from its core operations. The substantial increase in operating cash flow suggests that the company is efficiently managing its resources and generating sufficient revenue to cover its expenses, resulting in positive operating cash flow. The company's debt level and interest expenses have undergone significant changes over the past few years. Initially, the total debt reduced by over $10 billion since January 2023, contributing to a decrease in interest expense. However, this trend was reversed from 2026 to 2027, with the debt level increasing significantly. Despite the fluctuations, the company's interest expenses have generally decreased. In 2025, interest expense decreased by 23% to $1.3 billion compared to 2024. Additionally, interest expenses on dilutive convertible notes also saw a decrease in 2025. However, there are instances where interest expenses remained relatively stable or increased slightly. Overall, while the company's debt level has seen some fluctuations, the interest expenses have generally decreased over time. The financial performance of various segments within the company has been analyzed, revealing both strong and weak areas. On a positive note, North America and Europe have demonstrated impressive results, with North America boasting an adjusted operating income of $3.233 billion and Europe achieving $1.61 billion in adjusted operating income. In contrast, the cruise support segment has struggled, posting an adjusted operating loss of $-468 million. This underperformance is notable and warrants further examination to identify areas for improvement. Overall, these results highlight the importance of segment-specific analysis in understanding a company's financial health. Management is optimistic about the company's outlook and strategy. The key priorities include differentiating the cruise lines to attract unique customer profiles, executing a sustainability roadmap to reduce environmental impact, and strengthening the balance sheet while delivering shareholder returns through disciplined cost control and measured investments. To achieve these goals, management plans to provide an exceptional cruise experience through strategic sourcing and supply chain management, build strong relationships with suppliers based on shared values and sustainability goals, and invest in comprehensive performance management systems and leadership development programs. Additionally, the company aims to pursue net zero emissions from ship operations by 2050 through various technologies, such as LNG-powered cruise ships and shore power. In terms of financials, management expects to increase operating income due to various factors discussed above and focus on managing credit risk exposures by conducting business with well-established financial institutions and diversifying counterparties. The company also plans to use existing liquidity and future cash flows from operations to fund cash requirements and reinstate quarterly dividends starting in 2026. Furthermore, management is implementing a capital program to improve ships and replace assets to enhance efficiency and comply with regulations, which is expected to have no material impact on financial statements. Overall, the company's strategy focuses on sustainability, customer experience, and financial discipline, positioning it for long-term success. Concerns about supply chain disruption and inventory buildup have been raised in various contexts. Supply chain disruptions can occur due to a range of factors, including international sanctions, heightened regulations around customs and border control, travel bans, and labor actions. These disruptions can impact demand for cruises to neighboring regions and lead to production or distribution problems. In addition to supply chain disruptions, there are also concerns about inventory buildup. This issue is particularly relevant in the context of port costs that do not vary with guest head counts, suggesting a potential mismatch between inventory levels and actual demand. Such a situation can lead to waste and inefficiencies in the supply chain. That concludes the financial summary for Carnival Corporation and PLC. Feel free to comment below, and I will be happy to answer them when possible.